finance fees, and then there is an operating lease.
There are internal auditors everywhere, then how did that Vijay Mallya fraud even happen?
Gross profit will give me the sales.
Are internal auditors as independent as external auditors?
Now, throughout the course of your financial reporting studies, there is one term that will keep on getting repeated again and again in almost every discussion, every standard, and that term is fair value. Now, initially, when I started off as a student back in the day, the concept of fair value was not so prevalent. It was being discussed at a couple of places, but it was not a part of the mainstream discussion. Since the introduction of IFRS and Ind AS specifically in India, the fair value measurement approach has taken a lot of importance. Now, instead of having the term fair value described in every standard and spending 10 minutes discussing what is fair value, a separate standard, a separate discussion has been made for that, which is under IFRS 13. IFRS 13, which is fair value measurement. Now, before we understand to what all standards is it applicable, one of the points that you need to keep in mind is that fair value measurement as an accounting standard specifically applies to almost every area, but there are two specific areas where this particular standard does not apply. So instead of making a list of where all it is applicable and then spending a lot of time remembering that, let's just understand the small list where all is fair value measurement not applicable. First, it does not apply to leases, that is IFRS 16. You will not have references to fair value measurement in IFRS 16 and IFRS 2, which is basically share based payment. This standard gives guidelines on how is fair value calculated. Are there different approaches to calculation of fair value? What is the basic guiding principle behind each of these? That is what IFRS 15 is specifically going to talk about. Okay. With that in mind, let's now understand how exactly do we define fair value. Now, fair means not biased. Fair means not affected by any unnecessary factor. So, for example, if I am doing a transaction with my sister, I am tired of this laptop and I want to get a new one, I decide to give it to her. But because it's my sister, I would not charge her the actual market value of this laptop. I would say, oh, because you're my sister, I will sell this to you for 10,000. Now, the value at which I am selling this laptop to her is not the actual value at which it could be sold in the market between two unrelated parties at that particular day. Because my sister is involved, because a blood relation is involved, this transaction is not at an arm's length. This particular transaction value is affected by factors other than the market conditions. So, when I'm talking about fair value is the price that would be received to sell an asset or amount paid to transfer a liability between two unrelated parties or market participants in an orderly transaction at the measurement date. So, what exactly is fair value? Okay. Price received on sale of asset or paid to transfer a liability Price received on sale of asset or paid to transfer a liability between market participants when I say market participants, these are basically unrelated parties. Okay? Unrelated under normal under normal market conditions at the measurement date. Okay. Now let's pay attention to this part under normal market conditions, which basically means that the parties to the transaction should be participating in the transaction of their own free will. There cannot be any coercion, there cannot be any undue influence that has an impact on the price discovery mechanism. That is what we mean by fair value. So if I am selling my laptop, which is a second hand laptop, I put that ad on OLX, there is a price discovery that happens. What do we mean by price discovery? I have quoted a price, say for example 20,000. There is a basic bargaining that happens between me, the seller, and the other person who is the buyer, and based on the negotiations between us, we arrive at a price. That price is my fair value because it is amount received on sale of asset between market participants who are unrelated under normal market conditions at the measurement date. Now, we have to make one basic assumption that these market participants are unrelated then they have full market knowledge, as in no information is hidden from them at the time of making a decision, and the decision that they make is not under any coercion or undue influence. Okay. So any decision that they make at this point is not under any coercion or undue influence. Now, you have to understand that the participants cannot be forced into a transaction. For example, there is a person who owns a flat and he wants to sell everything off and move to another country. Or there is an emergency in his family, say for example, there's a major surgery of some family member because of which the person needs urgent cash. To get that cash, this person sells off his house, sells off his 2-bedroom apartment at whatever price the first buyer is willing to offer him. Why? Because he is in extreme urgent need of cash. Under these circumstances specifically, he was forced into entering into this transaction. He did not enter into this transaction out of his free will. He needed the cash, which is why he said yes to the first person who came to him. So the amount that he would receive on the sale of this particular building would not be considered to be the fair value of this building. Okay. Now, there are 3 approaches that we can think of when it comes to determination of fair value. The first is market-based approach. Wherein you consider the current market value, the price at which this asset could be exchanged between 2 willing participants at the measurement date, or you have the cost-based approach. The cost-based approach is very specific. It helps you in calculation of replacement cost or replacement value on that particular date. Or you have the income-based approach. What is the income-based approach? Income-based approach basically tries to talk about the income generating potential of a particular item, and based on that it helps you to arrive at the fair value. So the third approach is the income based approach. Now you might have a question that all these approaches are fine, but how exactly or what data points do you use to calculate any of these numbers basically? I mean, if I want to calculate the fair value of this second-hand laptop, for me the best possible way is to list it on a site called OLX. I'm sure all of you have seen that site at some point. You list this particular laptop for sale on that website, and there you will know what is the amount that buyers are willing to pay to purchase a second-hand laptop, and that will help you in your price discovery mechanism. So the question after understanding the three approaches, or to understand the approaches better, is to know how do you even arrive at the price. Okay. So the question is, which data points do you use in order to arrive at that price? Okay. So IFRS 13 talks about three types of inputs. Three types of input information that can serve as the base for determination of the fair market value, or the FMV in these cases. I call it, or not me, the accounting standard calls it level 1 input. Okay. There are three types of inputs that we are going to look at. Level 1 input specifically talks about quoted prices for identical assets in active market. Okay. This is quoted price for identical assets in active market. Now understand one thing, there are a lot of words that you have to pay attention to. The first of which is quoted prices, which means this particular asset has to be quoted on a particular exchange or a particular platform. If I'm talking about shares of Reliance India Limited, I hold 10 shares of Reliance India Limited. Today is 31st of March. I need to calculate the fair market value. What I will do is, I know that the share of Reliance India Limited is quoted on the Bombay Stock Exchange or the National Stock Exchange. I will open the stock exchange website, I will calculate, or I will look at the price that is printed on, that is written on that particular website. That is my quoted price. Quoted means that particular item is listed on a stock exchange or a website. If I am talking about, say, a stainless steel mixer grinder or something like that, the price is quoted on Amazon, which means again it is quoted somewhere. The second word that I want you to pay attention to is identical asset. It has to be the same kind of asset. Now, for example, I hold shares of Tata Motors, and Tata Group has multiple companies, and you know that there are other companies also which are operating in the automotive segment. Now, in the automobile segment, these are similar assets. They are not same assets. If I have to calculate the fair value of my Tata Motors ka share, I have to look at the quoted price of Tata Motors ka share only. I cannot look at some other asset ka value and then utilize that and to perform some calculations to arrive at fair value. It has to be the same kind of asset, which is why the word used is identical asset, same asset. If I want to know the fair market value of my iPhone 14, it has to be iPhone 14 ka listed price on OLX. I cannot say iPhone 13 ka, take the iPhone 13 ka price and add 5,000 to it because iPhone 14 is a better version or an upgraded version. You cannot say that. And the third term that I want you to focus on is active market. An active market is one where transactions of sale and purchase happen with a sufficient amount of frequency and regularity. Those are active markets. Okay. So level 1 inputs are quoted prices for identical assets in an active market. Level 2 input level 2 inputs. This has three features or three categories. The first one is quoted price for similar asset in an active market. Okay. Again, this is quoted price for similar assets in active market. Now, if you observe, there is a small difference between this one and the previous one. The previous one, level 1 input, was quoted price for identical asset. This is quoted price for similar assets in an active market. Then quoted prices, let's write down the three categories first and then we'll discuss them. Quoted price for identical asset in less active market. And the third subcategory in the level 2 inputs is observable inputs other than prices. Okay. These are all observable inputs, that is, you can see and point it out on some website or some platform. Okay. Observable inputs other than prices. Okay. Now, quoted prices for similar assets. We were discussing iPhones. iPhone 13 का identical asset is iPhone 13. iPhone 13 का similar asset is iPhone 14. It's similar. It's not the same. When I use the word identical, it has to be the same. Here the word used is similar. So, quoted price for similar assets in an active market is your level 2 input. When you are going from level 1 to level 2, naturally, it indicates that the level of credibility of that input is slightly lower. Level 1 inputs are the most credible ones. Level 2 is slightly less credible. So, if I want to calculate the fair value or I want to estimate the fair value of an iPhone 13 that I have with me as a part of my asset base, I cannot find a similar iPhone 13 ka quotation on 31st of March, but on OLX website on 31st of March, I can see an iPhone 14 listed somewhere. It is a similar asset in an active market. I can use that as the base for estimation of my fair value. The second one is quoted prices for identical assets in a less active market. When I use the term active, I am basically looking at the frequency, the number of transactions that take place. If you were to think of, the sabzi mandi next to your house, there the sale and purchase of vegetables happens with a very high frequency. That is an active market. But if I'm talking about, say, something like stamps, now stamp collection as a hobby is, slowly going out because nobody sends letters these days anyway. So the market for sale and purchase of rare stamps might be the number of transactions, the frequency of transactions is less, so that market could be a less active market. So, quoted prices for identical assets in a less active market. The third one is observable inputs other than prices. Now, what do we mean by inputs other than prices? Price is the amount at which that particular item is sold.